Greetings to all our IMAPS clients and investors. Let me walk you through the latest changes made during the first week of January. The US equity market closed 2024 as one of the best years in economic history. The Fed remained consistent in its well-telegraphed path towards lower rates, at the same time leaving the door open to pause sooner than expected if conditions require a more hawkish approach. Undeniably, 2024 was a year that will have its own chapter in future economic books, perhaps exemplifying the first instance of economic deceleration without a landing or recession. Within that context, credit metrics, labor market, and to a certain extent, consumption figures have declined from all-time high levels, but not to the point of concern. Our proprietary recessionary indicator is assigning only an 11.64 recession probability in the US the next 6 months. It is reasonable to expect a more volatile first half of the year, where the market will have to parse, dissect, and adapt to the policies that the new administration is expected to implement. Decisions related to tariffs, massive deportations might have an inflationary impact which could derail the Fed's ability to continue cutting rates. However, regulatory easing, a broadening of AI-related capital spending, and a change in energy policies could further support US exceptionalism. One of the biggest questions for 2025 revolves around the direction of the US fiscal deficit. Ex ante, it is expected to worsen as a result of combinations of actions such as tax cuts and other fiscal benefits, as well as an increment in government spending. This could be partially or completely offset with the drastic optimization and cost savings plans that Elon Musk is proposing to deliver, although it remains unclear how and when these are going to be implemented. The portfolio duration continues to hover a year longer than its benchmark to benefit from the decline in interest rates at the short end of the yield curve. Cash has been reduced in line with the expected continuation of the rate cut cycle to minimize its drag on performance. The high-yield portion of the portfolio observed a rotation towards managers with longer duration within that space. Credit risk metrics provide good support for the asset class, which, combined with private credit providing ample liquidity on the sidelines, could act as a shock absorber in case of unexpected widening of the current spread levels. We have reduced the allocation to long-dated treasuries given the more uncertain environment in the long end of the yield curve brought about by the worsening in the US fiscal deficit. As a result of the previously mentioned changes, we have increased the allocation to investment-grade mid-maturity corporate bonds to expand the allocation in the belly of the curve, making the portfolio less exposed to yield curve steepening. We hope you are well, and as always, please reach out to your financial advisor or investment professional with any questions you may have. Thank you.